Hi, everybody. This is Brad Addig, and welcome to the webinar, When is the Party Over for Commercial Real Estate by Doug Marshall. I'm going to be moderating this webinar, and we're going to take a couple minutes to let a few more people get logged in, and we'll get started in about 2 minutes. So hold tight, and we'll be right back with you, okay? Okay, so it looks like everybody's gotten logged in. And again, welcome to the webinar, When is the Party Over for Commercial Real Estate by Doug Marshall. Again, my name is Brad Addig, and I'll be moderating this webinar. Just a couple of housekeeping notes that are important. Everybody is currently muted now, so that'll keep down the background noise. We're also streaming this to YouTube, and a copy will be available. You'll get an email with a link to this webinar just in case you have to drop out early, or you want to show it, you want to see it again, or you want to share it with someone. And we encourage that you would share it. And also, Doug's going to encourage you to ask questions. So you should have a chat bar down in the lower right-hand corner of your screen. So make sure that you are typing in questions, because there's about 15 minutes of presentation here and about 45 minutes of Q&A. And now, Doug Marshall, take it away.
Well, thank you, Brad. Thank you for signing up for today's webinar titled, When is the Party Over for Commercial Real Estate? I really am looking forward to this discussion. Let me set the stage for what I would like to see happen over the next hour. This presentation was first presented to the Multifamily Northwest Apartment Association breakfast meeting earlier this year. The real estate market has not changed since then, and I believe this presentation is still more than relevant, and it's not only relevant for apartments, but other property types as well. I believe this topic is of paramount importance to those in commercial real estate, both investors and commercial real estate professionals. We need to know, or at least have an awareness of when there will be a downturn in commercial real estate. None of us, including myself, want to get caught with our pants down when the downturn occurs. None of us want to be surprised like we were with the meltdown that occurred in 2008. I believe this presentation. Am I right? So we will go through my presentation on this very important topic. It is relatively short, which gives us the opportunity to expand out into other pertinent topics of the day, such as what are interest rates are going to do in the foreseeable future? How does what's happening in China affect us in the United States? What is the current state of the U.S. economy? How will that affect commercial real estate? How does what's happening in the U.S. stock market affect commercial real estate? Which brings me to a very important point. Whatever we talk about needs to be viewed from a particular perspective. How will this topic, whatever topic we're discussing, how will it affect commercial real estate in the Pacific Northwest? That's the important thing to keep in mind. It's not good just to have head knowledge. It's the real important point is, how will this particular topic, whatever it is, affect us in the Pacific Northwest? Now, for this webinar to happen like I envision it, it will require audience participation. You are not a bunch of mindless robots. On the contrary, you are commercial real estate professionals and investors. You are risk takers. You are entrepreneurs. You have a wealth of knowledge. In order for this webinar to succeed, I need your input. I need your questions. So don't hold back. I want to hear what's on your mind. And maybe the best question that I could ask you to think about is, what keeps you up at night when it comes to commercial real estate? Let's talk about those things, okay? So let's get started.
Hi, everybody. We're back here, and we've gotten some great questions, and I want to encourage you to keep typing those questions into the chat box and make sure we get them. Doug, the first question. So when do you think the economy will go into a recession?
Well, that's not an easy question to answer. If you talk to any number of economists, they're going to waffle and tell you they don't know. And I'm just a lowly commercial mortgage broker. But let me give you a little bit of my thoughts on that. Right now, our economy is still growing. We are one of the fortunate few countries in the world where our economy is still growing at a modest pace. Europe is on the verge of recession. You've heard what's going on in China. Other parts of the world are having a very difficult time. And our first quarter GDP growth was just revised upward from negative 0.2% to a positive 0.6%. And the GDP growth for the second quarter was at 2.3%. Now, this is nothing to brag about, but it certainly seems like the economy is doing fairly well. What is going to happen, though, as a result of what I would call the current currency wars that we're experiencing right now, the last one being China devaluing their currency, it causes our currency in relationship to theirs to rise in value. And when that happens, our exports will begin to slow. So just like the euro and the yen, Japanese yen, we've seen a very strong dollar in the past year. And at some point in time, this will impact us as far as our economy. But at the present time, we're growing well. I don't think that we're going to see anything in the foreseeable future where our economy is going to go south and we're going to be in recession.
Okay, so that's kind of on the follow-up. If we do go into a recession, what do you think is going to cause it?
Well, I think it's going to be because of the world economy. I think it's going to be that we are so interconnected with other countries of the world that even though we are the strongest, the largest economy in the world, if China were to go into a true recession, which is possible, and we already think that Europe right now is in recession, I think it will be because of our export market beginning to decline, and that will cause the trigger that will slow down our economy.
Okay. There's been a lot in the news lately about the Fed, where they were getting ready to potentially raise interest rates. And now we've seen in the last 2 weeks a lot of changes happening on the global market and the stock markets. What do you think the Fed's going to do now?
Well, the Fed has been talking about increasing the interest rate for about a year, maybe even longer. And I've been saying for a long time that I don't think anything is going to really happen to interest rates in the foreseeable future. And the reason why is that the U.S. is interconnected with the world economy. All the other major economies of the world are lowering their interest rates right now in order to stimulate their economies. And if we were to increase our interest rate, there's a couple of potential negative consequences to doing that. One would be that it would cost businesses more to borrow, which would make it more difficult for them, which would slow our economy. And it would also strengthen the dollar when compared to other world currencies, which would then make our exports that much more expensive. So I am not thinking that they're going to raise interest rates anytime soon. But even if they did, let's say they did, what they raise is the federal funds rate between banks. And so this is like short-term lending is what they have an influence over. They do not have the ability to, they don't control interest rates like on the bonds. We forget that really market sets the interest rates. It's all about the law of supply and demand. And right now we have plenty of investors from around the world that are rates of the bonds out in Europe and in Japan are in many cases negative. They go out 5 to 7 years before they turn positive. So would you rather be a Japanese or a European investor getting a whopping maybe 0.2% on their 10-year treasury, or would you rather get a 2+% interest rate on a U.S. treasury and then have the impact of rising U.S. dollar? For example, last year, our dollar in relation to the euro and to the yen increased by about 14%, roughly. That means that they didn't get a 2% return on their money when they went with one of our bonds. They got a 2 plus 14%, so a total of 16%. And that makes it very, very advantageous for them to continue to put their money in our bonds.
Okay, so we're going to jump from the macro down to a couple of great micro questions. Jim has asked, what are the key factors for positioning property to get a loan that matches the sales price?
Give me that question again.
What are the key factors for positioning property to get a loan that matches sales price?
A loan that matches sales price. I'm not sure I understand the question. The best way to get financing that is most competitive is by putting together a truly good loan package for your lending sources. I'm not sure if that answers the question, but I know that for me, when I put together a loan package, I have everything in it that a lender could possibly want. So they not only have all the information on the property, but they also have the information on the borrower as well, so that when they take a look at it, they take a look at the complete package, they have everything that they need to be able to make a decision. One of the worst things you can do when you're talking to lenders is to kind of dribble the information to them. You have to give them something that looks professional, that is well organized, that answers all the major questions that they would need in order to get comfortable with the transaction and with the borrower themselves. So that's how it started. I'm not sure that was answering Jim's question. I apologize if I didn't.
That's okay. He can type in Jim can always type in something and clarify a little bit if that didn't.
Okay.
Another question we've got out there is, I'm looking to invest. What should I be looking for?
Well, that's a very good question. And we have a lot of well-qualified people today in our that are listening to this, could probably do a better job answering it than I can. But today, in this real estate market, with the values that we're seeing for commercial real estate, there's really about 3 different ways that you can go about getting a good a property that will be a good home run for you over the long term. And one of them is a value-added play. With the prices of commercial real estate being so high today with the compressed cap rates, one of the ways to get around that is if you can find a property that has not been well managed, if you can find a property that has not that has deferred maintenance, and go with a value-added play, you could still make a lot of money in commercial real estate. Another way that I think you can make a lot of money in commercial real estate today is by building. Your construction loan will be modest as far as what you're going to need to get for as far as loan to value and the requirement for the cash that you're going to require for the loan. But once you roll that into a perm loan, you're going to see very much an upside potential right off the start with that added value that you've put in there by taking the risk of building. And if you're not in one of those 2 categories, in a value-added play or building from scratch, the only other way that I think that you can really make money in today's market is by having a long-term hold. So if you're planning to buy today and you see that your cap rate has been compressed, it doesn't make a lot of sense today, but you have desire to keep it for long term, of 10 years or longer, then it really doesn't make as much difference what you're buying it for now. Over time, you'll get that return that you wanted.
Okay. And Jim came back, I think, when he talked about the key factors for positioning the property to get a loan that matches the sales price. He's talking about a piece of property that has low rents and some deferred maintenance, and probably looking to say, how can he get a loan to buy that piece of property, which sounds like that kind of fits in where you were talking about something with deferred maintenance just a minute ago.
Right. And so on something like that, you know, if you've got a property that has deferred maintenance, depending on how much of improvements you have to make as far as the property is concerned, you can go one of two ways. You can get a perm loan and with a holdback for those repairs, and that's one way. But if it's significantly in poor condition, the best way is to go with a bridge financing, which would be the ability to buy the property and then put in the capital improvements that you need. And it's like a construction loan. It lasts for 18 months. It's interest only. And then once you've made the improvements, you've been able to raise the rents on the property, get the property occupied, then you roll it into a permanent loan at that time. But the key is to find the right type of lender. And it really depends, first of all, is what the condition of the property is in. Is it just got a small amount, relatively minor amount of deferred maintenance that could be done with a holdback? Or is it so significant that the best way is just to go with a bridge loan, find a bridge lender that'll give you an interest-only loan, and then convert it to a perm loan when it's all been stabilized?
Okay. Back to a little bit more macro. Here's a great question. How does a declining stock market or a stock market in decline affect the commercial real estate market?
Well, that's a good question. And in the past week, we've seen our stock market decline precipitously. We had 6 consecutive days until today. The last time I heard today, the Dow was up a pretty healthy amount. But a week ago, the Dow Jones Industrial Average was at 17,500. And this morning it was trading at about 15,800 roughly, which is a 9% loss. And I think it's gone up today. So that's good news. But when you see a decline in the stock market like that, what that does, whether it's meant to or not, is that people get out of it. They sell their stocks. They can't take the loss. They don't have the fortitude to remain when the stock market is in that roller coaster, especially when it's going down. And so they pull their money out. And then the next question is, what do they do with it? And there's really about 3 things, maybe 4 things that they can do with their money. They can put it into some type of annuity, which will give them a modest gain. They can put it into bonds. And if you've noticed, the Treasury rates over the last week have declined quite a bit, because what's happened is all sorts of people have taken their money out of stocks and they put it into Treasuries. And when you have more people in the bond market, that causes a little bit of a imbalance in the market, and so the Treasury rates to make up for it will adjust downward. And so we've seen a pretty steep decline in bonds until I think today. I think they went up a little bit again because things have leveled off. And so that's another thing that they can do. The third thing they can do is they can put their money in commercial real estate. And I think that's also what's going to happen over the long haul. Once people become a little dissatisfied with the market, the stock market, and they've decided, you know, I don't really want to be in this anymore. It's too volatile for me, or I don't like the declines I'm beginning to see. They're going to see more and more investors going into commercial real estate, which just makes us that much more, will cause that those compressed cap rates even further when we have more people in a market for commercial real estate. So those are the things that can, how a declining stock market can affect commercial real estate.
Okay. I've got one that wants to know what's the difference between a leasing agent and a tenant representative?
Well, I'm not an expert in this area, but a leasing agent does exactly that. He helps with leasing, and a tenant rep would be also one portion of that. There's a landlord representation and there's tenant representation. And so a leasing agent could be for either one.
Okay. And then I've got a great question who I think is designed to stump you. Okay.
Probably will.
How many months was the last expansion prior to the 2008 recession?
Well, as I recall, it was like over 100. It was like over 100 months. It was a very long period of time. So right now we're roughly in the 73rd month of expansion. And that's the reason why I think it could go for, I really think it could go for another year before we see that decline. I am not at this time negative about the economy in general. I think the economy is, though it's not, going along lickety split, we'd love to see a growth rate in the 3 to 4% range, because when that happens, everybody's happy. But I just don't think it's going to decline or it's going to slow down anytime soon. And so I think we've got at least another year. So if you add another 12 months to where we're at right now, we're approaching, what would that be? It'd be about 85 to 90 months of continuous expansion. That's very long. So I think we're doing fine at this point on the economy.
Okay. I've got a question. Someone says they're just kind of getting started and they want to know what they should be looking at different types of commercial real estate, multifamily versus office versus bare land. What are your thoughts on all the different categories?
Well, the first thing I would do is I would find a trusted commercial real estate advisor, some real estate commercial mortgage, not a mortgage broker, a broker, a real estate broker for you. That, I think, is the first step in the process. And I would talk to your friends and ask them who they use and if they have any strong recommendation, because I think from there, that will flow to what type of property that you should be looking at. And I don't know enough about land to tell you one way or the other. I don't focus on the land side. I'm only on income properties. So as far as the major food groups, so to speak, you got office, retail, industrial, apartments. Those are the big ones. You have hospitality and whatever. But what I would do is I would focus in on getting a recommendation, maybe more than one recommendation, and interview some people that you could use as your trusted advisor for that particular question. Apartments have been the favorite child of the industry, commercial real estate, for years, and there's reasons for that. But it might be that with cap rates where they're at today, maybe that's not as favorable as the other property types. So it just depends on where you're located and where the value is at this particular point in time. Again, if it were me personally, I would go with a value-added play, but you can do that not only in apartments, you can do that in office and retail, industrial as well. You find a property that has not been well managed, and a property that has vacancy, a property that has deferred maintenance, and you can make those changes, take the risk involved with that, and you have a really good chance of making good money over the long haul.
Okay, good, thanks. So here's a thing I think that a lot of people that are getting started or probably have been in commercial real estate for a long time want to know. What are some of the mistakes that people have made that you've seen, and how can they avoid them?
What type of mistakes have people made? Oh, I think there are plenty of different mistakes they make, but I think one of them that comes to mind right off the top is people who buy out of state. I think it's really important that you have the ability to go buy your property, drive by it, see it on occasion, because if you're out of state, you can be abused by your property management company. They might not be doing a very good job for you. And I've seen that on many occasions where there's a property that's in decline, it's usually because there's an out-of-state owner, and he's trusting his property management company to do what's best, and they are not watching the property as well as they should. So that may be the first thing that comes to mind.
Okay. Someone's asking about insurable access to property.
And what's the question?
I think that's the question is someone had mentioned to them they should make sure there's insurable access to the property.
Insurable access. Are they saying they're having problems with easement on the property, to the property?
That's all I got on the question. So,
well, let them follow up with a follow-up question. I'm not sure what they mean by that, unfortunately.
Okay, all right, we can do that. And the last question that I have right now, so I need some more questions from the audience, is, hold on, let me just go through these real quick, is what are some of the key things that you should think about when dealing with a mortgage broker?
Well, I think that that's a good question. I think that I've been in this business a long time, and I think that you need to find somebody, let me say this, not all commercial mortgage brokers are the same. They're not all equal. And you need to find somebody that you feel really comfortable with. So what I would do if I were you is I would suggest, again, the process of asking your friends, do you have a mortgage broker or a lender that you like doing business with? Give me their name. And then you sit down and you interview them. And you ask them all the questions that need to be asked, just to get an understanding of their personality bent and how well you deal with them. So, you know, a lot of it's just personality. So I would start with that. I would start interviewing. I really would. That's a good place to go. And most people won't mind that if you just tell them up front, I'm talking to one of your, you know, 2 or 3 of your competitors, and I'd just like to sit down and maybe have a half an hour of your time just to ask you some questions about how you do business. So that's what I would start with. And I think that from there, the best way for choosing that person over the long haul is to be able to find out if there's more than one recommendation that's given to you. Usually that means that person is doing a good job. I would also ask that mortgage broker, can you give me some recommendation or give me some clients that you've done business with in the last 6 months that I might be able to contact them and see what they think of your job performance for them.
Okay, that's good. That's a fair answer. And I'm going to follow it up with one. What are some questions that people ask you?
Well, you know, that's a good question. And many times I don't really get interviewed, and I'm not sure why. I would think it would be important. One of the things that I do that may set me apart from most of my competitors is that I have a pretty good website. And a lot of times you can find out a lot about a person's ability, their personality from their website. And I also do a blog usually every 2 weeks. And from over time, by doing that, I found that people get to know me and have a pretty good understanding of who I am. I remember about 2 years ago, I had done a blog post, and I noticed that somebody on my distribution list who I'd never met before had clicked on it and given me an indication that there was an interest there, that he was in need of financing. So I called him out of the blue, and this was totally a cold call because we'd never talked before. And I just meekly mentioned my name, and he started talking to me like I was a long lost buddy, because he had been getting my blog posts every 2 weeks for the last 2 years. And so when I asked, would you like to get together? He said, absolutely. And so make a long story short, within about 60 to 90 days, I'd provided a loan for him. But the key was that he'd already known who I was by the blog posts that I'd been sending his way for the past 2 years. And as a result, he felt that he could trust me. And that's the important thing.
And it's time for a shameless plug for you as well, Doug. So you all should go to marshallcf.com. That's marshallcf.com and sign up for Doug's blogs. There are over 300 blogs you can go back and search through and read, and probably has a lot of good information that any of you might be looking for. So that's just a great resource. Doug, I don't have any more questions for you. Do you have any parting words? We're going on about 42 minutes right now. So if you got a couple of minutes to wrap up, and then we'll call it a day.
Well, I just want to say thank you for everybody that came to the webinar today, and hopefully this was information that was of value to you. And if you have any questions or concerns, please feel free to either contact me. You can call me on my phone. You can send me an email, whichever way works best for you. Thank you for coming today.
And you guys will all get an email with this recording. I would really encourage you to pass it along and share it with friends. And again, we really appreciate you coming and listening in. Thanks again.